Welcome to the Introduction to Tax Law. If you were teaching a tax course, how would you start off teaching the course? Well, one way to introduce the subject is to define what exactly it is. Maybe talk about some different examples of taxes, even give some history, or possibly even talk about what makes a good tax, because taxation is something that affects everyone. Well, let's talk about a little bit of all of those different elements to introduce tax law. First, let's focus on the definition of tax. Well, there's been many different definitions of tax over the years. One good definition, coined by Ray Sommerfeld, a tax is a non-penal yet compulsory transfer remitted for the public good. So that phrase actually is chock full of different items we can dissect. One thing to think about, we're going to emphasize this throughout the video, when we're talking about taxes, we're talking about governments collecting money in order for the government to create a civilized society where the government's able to provide services, provide different securities and whatnot for the citizens of that society. Now, we're not going to go into the specifics of whether that should be something the government does or whether the citizens, they do it themselves, more of a free market type idea. But that's the general idea. If you ask somebody on the street, what exactly is the purpose of a tax? It's really to raise revenue for the government. And that is the general case. There's other reasons for taxation, but that is the main thing. And that's going to be a major emphasis in this video. Part of this definition focuses on a non-penal yet compulsory. So a tax is not a penalty. As you know, in the U.S., or you might not know this, but in the U.S., taxes are actually a voluntary system because you file your taxes on your behalf. You don't have someone coming to your door, inspecting everything and doing it involuntarily, okay? You actually voluntarily file taxes and fill it out. Well, you're saying, well, how is that? Because if you don't submit your taxes, you get fines, you get penalties, and you're exactly right. So even there, we have a voluntary self-assessment system where you, as an individual citizen, you actually file your own taxes. There is an involuntary element in the sense that there's fines, jail sentences, and even other things where the government can even come in and take potentially part of your wages or whatnot, or property. Another element deals with, again, the public good. As I focused on, we're focusing on governments raising revenue for the governments, but there also might be other elements such as encouraging behavior in society. So focus on not only that taxes are used to raise revenue, but they're also used in other elements by the government. So we'll talk more about that when we get to what is a good tax. All right, let's talk about the types of taxes. So taxes affect everyone. There's so many different types of taxes out there, and taxes affect almost every type of transaction that's around us. Okay, some examples are sales, loans, gifts, purchases, leases, wills, and numerous other events. So even on your death, you have to worry about tax, which is kind of interesting because you're dead and you still have to worry about tax. Well, of course, your heirs or whoever's left to deal with the bills, they have to focus on the taxes, right? But that can create tax issues. So that shows you that tax affects every aspect of life. Now, governments, there's just so many different types of governments out there. There's obviously the federal government. There's state governments. There's municipalities. There's townships. There's parishes. There's school board districts. There's water districts, water management districts. There's so much more in terms of what exactly is a jurisdiction for tax purposes for raising the revenue with respect to those items. Special districts. There's just so much. Again, the main focus is our main focus of taxes to raise revenue for these different types of governments. So we're going to talk about the different types of taxes out there, and we're going to focus on, with respect to certain types of governments, what the main focus is for that type of government in terms of how they tax their constituents. So let's talk about political subdivisions and municipalities. So we're talking about cities, counties, school boards, special districts, water management zones, all these different things. Basically, below the state level, because we're going to talk about states and obviously federal after this, but we're starting with the political subdivisions and municipalities. So the main way that these tax their constituents deals with real property taxes and personal property taxes. Again, we need to look at the fact that where the governments are trying to raise revenue from and perform their services for the public good. Now, there's also fees. Fees are not the same thing as taxes. Fees are more direct correlation, whereas taxes, yes, they provide benefit to all, generally speaking, but fees are more direct relationship. Okay? Fees and tolls are not the same as taxes. You might have a toll on a highway and you have the privilege of using that highway, like a turnpike. Okay? That is not the same as a tax. That is a more direct relationship. Taxes are more about, again, the public good and to live in a civilized society. Okay? The governments need the revenue in order to provide safety, defense, roads, all these different, schooling, all these different things. So real property taxes are the main way that the political subdivisions in municipalities like cities and counties and all of these elements, how they get their tax revenue, their revenue for their budget. Now, real property taxes are levied annually on ownership of real property. Real property is the land and everything attached to the land, and then personal property is everything else. So we're talking about land and then buildings on the land, all that stuff. And there's, of course, other stuff that could be considered real property because it could be attached to the land. But usually it's the land and the buildings attached, the housing, the buildings on the land and whatnot. Since the amount of tax is generally based on fair market value, this is referred to as a ad valorem tax. Okay, so we're going to talk about the federal taxes, and we're going to focus a lot on the federal income tax later on, but that is not a fair market value based tax. There are some federal taxes like the estate and gift tax that focus on fair market value, but income tax does not generally focus on fair market value with respect to each year levied on the fair market value of the item. That's not the case. So elected or appointed government officials collect, they're tax collectors, they assess the amount of value of property. So you have a tax collectors and tax assessors out there. Basically, these are elected and appointed government officials. Now, if you're a property owner and you disagree with the assessed value, you can challenge the value in an administrative proceeding. And then if that does not go the way you want, you can also potentially take it to a judicial proceeding to be reviewed for that element. There are permanent tax exempt statuses. So some types of taxpayers don't have to pay real property tax, usually viewed as just like the federal government, charitable, religious, educational organizations, those kinds of things. And there's also abatements where, for example, maybe to entice a business to come to the area and create jobs and growth for that specific city, county, whatnot, that municipality might provide some type of tax abatement, maybe temporarily or maybe even for 100 years, where it says, you know what, you're not going to have to pay any real property taxes because we want to encourage you to come in. There might be some famous theme parks in Florida that may have been enticed to come to Florida for that reason. I'm not going to say anything specific. You might want to take a look at that on your, search that online. That might be one reason why they came to Florida. So really the tax plan in this area for real property taxes, it focuses on assessed values and negotiating tax abatements. That's really the focus. Another aspect, another area that municipalities focus in terms of getting revenue is personal property taxes. So very similar idea to real property taxes where it's subject to fair market value. The only element that's really, the main element that's different is it's not real property, it's personal property. So it's everything other than real property. Again, real property is the land and everything attached to the land. So there's three general categories of taxable personal property. The first, household tangible personal properties. So automobiles, boats, recreational vehicles, private airplanes, and a bunch of other items, but those are some big ticket items. The second category is business tangible personal properties, like inventory, furniture, fixtures, machinery, equipment. Those are all big elements. So if you have a business, of course, you have the real property tax on the building and the land, but then like a factory. But then if you have equipment inside, you're going to have to be subject, you might be subject to personal property tax on the machinery, equipment, inventory, all those different things. And finally, some municipalities have personal property taxes on intangible properties, like accounts receivable, stocks, bonds, even intellectual property like patents, copyrights, trademarks, even those types of things. So just like the real property tax, the tax planning here involves dealing with assessed values and elements related to maybe getting some type of exception or exemption not to be taxed or abatement. So state governments most of their revenue comes from sales taxes or sales and use. I group those two together. Excise taxes and income taxes. That's where they get most of their money. There's also fines and penalties and service fees and whatnot, but that's really where most of the revenue comes from: sales taxes, excise taxes, and income taxes. Let's first talk about sales and use, which I've grouped together as sales taxes, but they are really different. So sales taxes, as many of you know, they occur at the point of sale, and the seller has to collect and then remit and send back to the state or whatever whatever government is requiring the sales tax. It's to remit that tax to them. So the seller is responsible for collecting that on behalf of the buyer. Use taxes are actually when a user of property uses the property in the state. And the idea is that the sales and use tax work hand in hand. If you weren't taxing a sales tax in a specific state and then you use it in a state, you're supposed to be subject to use tax. So some states, for example, do not have sales taxes. So the idea is that if you go to a state that doesn't have a sales tax and then you buy something, but then you bring it to a state that does have sales taxes and then you use it there, you should theoretically be subject to the use tax, assuming that the laws apply to that item. Of course, sales tax is what you mostly hear because most transactions, they're really subject to the sales tax. But again, the use tax is really kind of the backstop if you kind of get around the sales tax. So generally speaking, sales taxes, again, you see them being collected at the point of sale. That's the general rule. Now, there's a lot of interesting tax issues involving sales taxes. You might have gone to the grocery store recently and purchased something and noticed that, hey, some items, there's no sales tax. It's not subject to sales tax. Most food items in a grocery store, that's the case. However, if you were to go to a restaurant and purchase a meal that was prepared for you, because there's an element of service there, it's not just a good, it's not just a food necessity good, you notice that it's always subject to sales tax, and that's the case in almost every jurisdiction. So there's some specific issues. In some states, things like ice cream, depending on the size of the ice cream you purchase at the grocery store, it might be subject to sales tax, it might not. So the idea is that you might think about those little convenient ice cream cups, and it might be viewed more as like a convenience, more of like a service item, like you get it like a gas station, which they still sell at the grocery store. But then if you buy a large size, like a pint or more, or a half gallon or a gallon of ice cream, not subject to sales tax. So it's like, that's very interesting issues. And there's tons of other elements. I just give ice cream because everyone loves ice cream, right? So many different flavors, so many different, everybody loves ice cream. Ice cream is just one example where you might be subject to sales tax, you might not. Now, one area of sales taxes, sales and use tax, that has become very interesting and very important, a very popular area when it comes to sales tax, deals with internet online shopping. So in 1992, there was a case called Quill Corporation versus North Dakota. And basically that case, without going to the specifics, because I don't want to focus this conversation or make this into a SALT presentation, but that case basically said that if a seller has no physical presence in a state, then it's unconstitutional for the state to require the seller to basically withhold sales taxes on behalf of the buyer. Because the idea is that the seller has no physical presence to that state. So this Quill Corporation versus North Dakota, what it dealt with back in 1992, I mean, internet was not a big deal, especially internet shopping was not really a thing, but it dealt more with magazine and mail order purchases. So in the state of North Dakota, this Quill Corporation had no physical presence. It didn't have any offices, any warehouses, any inventory, anything like that where it had physical presence, but it was selling to customers in North Dakota, maybe through a magazine, a mail order item where you could sign up. The idea is that no sales tax was required to be collected under this case by Quill because Quill did not have any physical presence in that state. Now, again, the use tax is what comes in and is supposed to provide that person that purchased from Quill Corporation North Dakota is now subject to use tax, but that's another issue, whether the taxpayer actually files a use tax return. That's another issue, okay? I have an example here. It deals with New York and Florida. You can take a look at that, but it's the same element, okay? Same element. So, of course, from 1992 until 2018, internet shopping became very, very, very popular with internet retailers like Amazon and even retailers like Walmart and Target having a huge portion of their sales going from the brick and mortar stores to online. So in 2018, South Dakota versus Wayfair pretty much overruled, and both these cases are U.S. Supreme Court cases. South Dakota versus Wayfair pretty much overruled the Quill decision, and now what it allows is for states to basically have laws that say that when when a seller does not have physical presence in a state, they can collect sales tax on behalf of a buyer if there's economic nexus. Economic nexus. Okay, economic nexus. That's really the focus. Economic nexus. Now, of course, what is economic nexus? That's an element to wonder. But the idea is that it is possible for an online retailer with no physical presence in a state to be taxed by the state from a sales tax purpose. Well, I should say the seller. The seller is the one taxed. The buyer, I'm sorry, my apologies. Reverse that. The buyer is the one taxed. The seller is the one that must collect, right? That's the idea. You all dealt with sales taxes before. You know that as the buyer, you're the one ultimately paying the tax. But the seller has to collect it. So the question is the seller responsible for collecting it on behalf of the buyer and then turning that sales tax form in with the money to remit it back to the state of South Dakota, Wayfair here, okay, an online retailer? And the answer by the Supreme Court is yes, a state can require that, but economic nexus is basically what's needed. Now, there is potential for someone out of state to get a credit from another state because they live in a certain state, get a credit, and they're not subject to double taxation when it comes to sales tax, basically. They don't get hit twice with the same tax. Now, again, through the combination of the sales and use tax, the idea is that really a state should be taxing properly, both either at the sales point or the use point, a user or a purchaser of items in the state. Okay. Again, that's why the sales and use tax is such a big revenue driver when it comes to states. And there's other municipalities that use sales taxes like counties and cities and whatnot. They're not the only ones, but for states, it's mostly sales and use tax that you see. Now, one thing I mentioned the use tax, and you're like, well, I've never filled out a use tax return. Well, that's been one issue, and states are becoming more and more aggressive when it comes to use tax. They are actually going after a lot of times businesses, because of course that's where the big money is. But as we go more and more into a system where it's easier to record this stuff, you're going to see that use taxes, their states are going to go after individuals when they're using property. So excise taxes are kind of like a sales tax, but they focus on only specific items. For some examples include gasoline, cigarettes, alcoholic beverages, hotel, motel combinations. Basically, the idea is that you might have gone to a hotel or motel, like in a state like Florida, which is very much driven by tourism. And not only do you see sales tax, but you see an additional tax for tourism. That's basically on hotels and motels. That's basically an excise tax. The idea is that state is generating more revenue from that specific activity. We also have corporate income taxes and personal income taxes. So most states have corporate and personal income taxes. Some states do not. Depends on the state. I'm not going to go into the specifics because we're going to focus on federal income tax in a moment and for the rest of the presentation. But the idea is that generally you're going to see around 4 to 12% rates for corporate income taxes, and for personal income tax, 3 to 12%. Usually both the corporate income tax and the personal income tax, they start with federal taxable income and they adjust. And they talk about, okay, we conform for the federal tax law for this issue, but maybe not this issue, and it adjusts. That's really the idea. It piggybacks off of the federal tax concept. Okay, so I'm not going to go into much more detail, but we're going to talk about the federal income tax, and whatever tax class you're taking, I guarantee federal income tax is a big focus. The idea is that a state income tax, whether it's corporate or personal, very similar in terms of it's an income tax, similar issues, and we even start with federal taxable income and we adjust from that. So foreign governments even have their own taxes, and that makes it pretty much We could have infinite taxes on a taxpayer depending on how involved they are around globally. I'm not going to go into every single little country, but if someone is dealing with, if a corporation or a business has activities throughout the world in 50 countries, you have to worry about multiple countries taxing different taxpayers. You don't want to be double taxed or whatnot. And there's a whole tax regime and system in the U.S. system and for outside the U.S., inbound and outbound, dealing with international tax. That's all I'm going to say about that. We're not going to go in much more detail, but foreign governments have taxes as well. So now let's talk about the federal government, because we're going to focus the rest of our discussion, the materials, on federal income tax. But let's talk about the different taxes the federal government has. So the main ones I should say, deal with income tax. Personal and corporate income tax, they account for around 60% of tax revenue in the U.S. There's also employment taxes like FICA, right? Those types of taxes. They account for around 35% of tax revenue. Excise and transfer taxes provide pretty much the remainder. So excise taxes, just like we saw for the state issue above, we're dealing with taxes on specific items like alcohol, gas, cigarettes, different things that the federal government is taxing additionally. Transfer taxes. So transfer taxes are actually an excise tax, and they're assessed at the right to transfer property at death or during life to circumvent the estate tax, we call it. So there's really three different types of transfer taxes, okay? There's the estate tax, which is a tax at death. There's a gift tax, which is basically was created to prevent avoiding the estate tax. And then there's a generation skipping tax, which closes a loophole in the estate tax by transferring to at least 2 generations below you, okay? Because you skip a generation. So these are all based on fair market value, but income taxes are all based on different notions of income. So for the remainder of the materials in here, we talk about the history and also policy. We're going to focus on the income tax because, again, regardless of what kind of tax class you're taking, most likely you're focusing on the income tax. It's possible you could be taking a wealth transfer tax, but focusing on the income tax is going to help you because income tax is such a huge element. I mean, it makes up, again, around 60% of the tax revenue in the U.S. So let's talk about history. Everyone loves history, okay? Before we go into the specifics of history, and we're following the history of the U.S., because we're dealing with the U.S. federal tax, right? The history of the U.S. federal tax. Let's talk about the Constitution. Specifically, in Article 1, Section 8, Clause 1, it states that the Congress shall have the power to lay and collect taxes, duties, imports, and excises, to pay the debts and provide for the common defense and general welfare of the United States. But this power has not always been exercised by Congress, okay? So the idea is that even though that's been in the Constitution, right, this clause, okay, that doesn't mean that it's always been used. So let's go all the way back to the beginning of the U.S. Even before we have the Revolutionary War, in 1600, specifically 1643, we have the first attempt to tax incomes in the U.S. It was what's known as a faculties and abilities tax. Now, basically, it was a modest tax where tax collectors were going around door to door and asking if the individual had income during the year. If so, it was computed and calculated and money was taken on the spot. Now, imagine that today. If people were going around, tax collectors, calculating your tax door to door and taking the money right there. There would probably be a lot of rioting and a lot of people not liking that system. That's why we pretty much have gone to what we call a voluntary system where it's self-assessed. So let's move over to the next century, in the 1700s to 1800s. In the early 1700s and well into the 1800s, a number of southern colonies and states adopted an income tax modeled on the tax instituted in England. So you might recall that during the 1700s and 1800s, there was this struggle where you had the North and the South, in the sense the North was where a lot of business and development was growing, and then the South was where all agricultural stuff dealt with. So there were a lot of tariffs and tariffs deal with imports and exports. So there were a lot of tariffs in the 1700s and the first half of the 1800s on exporting cotton. So an exporter of cotton from U.S. to England will be subject to paying a tariff, and that's where a lot of revenue for the U.S. came from, tariffs. Well, the South didn't like that. The North liked it because, hey, the North was never pretty much subject to having to pay any tariffs or taxes, and the South pretty much made up paying most of that. So the South tried to institute taxes on their own constituents and citizens, and this is not the South from the Civil War. This is just saying the Southern colonies. Well, this was instituted after the British tax, where basically it was a tax on income. So that's where we get our income system from, is the British system, and not on property. Now, the British theory was that you tax the income from the property and not the property itself. Okay, you tax the fruit, but not the tree itself. So the idea is that if you have a corporate bond and you receive interest from the corporate bond, the interest is taxed, but when you sold the bond for a gain, there was no tax on the sale of the gain. Of course, that's not what our system is like today, but that's how it was back at that time. The idea is that we tax the fruit of the tree, but not the tree itself. So if you sell the tree, we don't care about the tree itself. All right, so then we move over after the Civil War, during the Civil War, I should say, during that period of time, we have our first income tax, our first federal income tax from 1861 to 1873. The Union enacted the first federal income tax designed to help finance the Civil War. Now, tax rates were 3% on income exceeding $600 and less than $10,000. So between $600 and less than $10,000, 3% on income, and then 5% on income exceeding $10,000. Now, if we had a tax like that today, man, everybody would probably be like going crazy because they'd be happy. Of course, that's not what we have today. Okay, but so it wasn't that. It was very small tax, but still, it was the first tax. So the tax, even though it was modest, or I should say, it was not too large, right? Did provide substantial funds for the war effort. So after the war came, and finally when the federal revenues were in a surplus, basically Congress let the tax expire in 1873 as it intended. So now we have 1880. In 1880, we have individuals during the 1870s basically challenging the federal income tax that happened from 1861 to 1873. So in 1880, we basically have a U.S. Supreme Court case called Springer versus United States. And what it did was it basically challenged the federal income tax that occurred from 1861 to 1873. And the Supreme Court basically ruled that this tax was constitutional unanimously. The taxpayer contended that the income tax on his professional earnings and personal property violated the direct tax requirement of the Constitution, which I'll explain below when we get to 1895, what that really means. At this time, it was hard for the Supreme Court to be interested in a case involving a tax that expired 7 years earlier. So we're 1880, it expired 1873. The Supreme Court said, okay, even if your point is correct, the tax hasn't been relevant for 7 years. So we don't care. We're wasting our time. Let's just rule for in favor of the government. So of course, that was just a lazy argument by the Supreme Court. But you'll see that in 1895, the actual Supreme Court does take up the issue, and we focus on the fact that capitation versus excise issue. So 1894, Congress wants more revenue, and it basically brings back the income tax. So a new tax law was passed that year. Grover Cleveland, it was controversial. President Grover Cleveland signed it into law, and that's in 1894. So 1895, we have a taxpayer challenging the legality of the income tax in 1894. So this kind of goes back to the 1861 to 1873 issue of the income tax. But again, in 1880, in the Springer case, the court said, well, there's no tax anymore, so we don't care. So now in 1895, we're saying, the taxpayer saying, well, I have an argument for why Congress has no right to tax me the way they're doing on income. And now there's also an income tax. So now, Supreme Court, you actually have to decide. You can't just punt. You have to actually decide. So here's what happened. The case is called Pollock versus Farmers Loan and Trust Company. A taxpayer is basically suing a corporation. You're like, well, why are they suing a corporation? Why aren't they suing the U.S. government? Well, it's because the corporation was trying to collect tax, okay? So corporation sued the corporation in which he owned stock, contending that they should have never paid the income tax because it was unconstitutional. I'm sorry, I said earlier that the corporation collected tax from the taxpayer. No, the corporation basically paid tax. So the tax was on this corporation, Farmers Loan and Trust Corporation or company, and that corporation actually paid tax. But one of the shareholders basically said, no. One of the owners of the stock of the corporation said, no, you shouldn't be paying tax because it's unconstitutional. So that's what the issue was. Corporate tax, corporation pays tax, shareholder says, no, you shouldn't be paying the tax, don't pay that. It did. So then the shareholder sues the corporation. So in this case, the tax was paid on income from land, and Pollock argued that since a tax on real estate is a direct tax, a tax on the income from such property must be a direct tax as well. So real estate is a direct tax as it relates directly to the property itself. Okay? And then any income from that property is also viewed as a direct tax as well because it's coming from that specific property. And since the Constitution prohibits a direct tax, at this time in 1895, the Constitution did prohibit a direct tax unless certain conditions are met. The income tax should be declared unconstitutional. So I'm going to read you the section 9, clause 4 of the Constitution where it dealt with this. So the direct tax argument was also used by Springer in 1880, but remember, because the tax lapsed in 1873, the court just said, well, so what? Doesn't matter. Even if we rule it's unconstitutional, there is nothing. So we're not going to waste our time thinking about this issue. Well, now they have to think about it, basically, is what Pollock is saying. So here's what the Constitution says. So in Article 1, Section 9, Clause 4, the clause stated the following: but all duties, imposed, and excises shall be uniform throughout the United States. So uniformity, that's important, uniformity. Number 2, no capitation or other direct tax shall be laid unless in proportion to a census or enumeration herein before to be taken. So here's the issue. The idea is that if there's a direct tax on every individual owner on their income, well, it needs to be basically apportioned or uniform throughout the states based on their population. So each state needs to make up a portion based on ownership. So that way, based on the wording of the Constitution, if you live in a state with more individual owners, you should be paying technically less in tax. I'll explain. We focus on the census. So in effect, this clause required any direct tax to be based on census. For example, if the government desires to raise $10 million from the tax, and New York has 20% of the total population at the time, which it probably did, then New York will be required to raise $2 million, right? Because again, it's a focus of the proportion of to a census based on how many people live in the state. Now, we don't have that today on the income tax, right? Because obviously larger states like California, Florida, New York, that means that they basically would have to pay a percentage of the population, total population, and then that state would make up a percentage, right? And then if you were in a smaller state, then that's how it worked. This is just based on everyone nationally, right? That's how this is working in this example. So if you're in New York during this time, New York had 20% of the population, so New York should be giving $2 million of the $10 million needed to raise. And if New York has 1 million residents, then each resident would owe $2 in taxes. That's basically how it worked. That is viewed as a proportionate tax. We didn't focus on the income. We focused on, a head tax. There's 1 million people in the state of New York, okay? So each person pays $2. We call that a head tax. Obviously, a tax based on income could not achieve such proportionality since incomes differ across individuals. You can't say, okay, well, this individual might owe $10 in taxes this year, but this individual only owes $1, and this individual owes $7. And then, from that, we get the $2 million needed from New York. No, everyone owes proportionally the same. That's how the Constitution read. So the court, in a 5-4 decision, ruled that the income tax in 1894 was unconstitutional because it did not meet the uniform and proportionate to a census measure. So effectively, this repealed that income tax that was enacted in 1894. So from 1894 to 1909, no taxes, no federal taxes. Then in 1909, Congress takes 2 actions. First thing, they pass a corporate income tax, but they label it an excise tax on the privilege of doing business. So because it's labeled as an excise tax, there's no issue with the Constitution that we mentioned earlier. The tax was 1% of all income exceeding $5,000. Secondly, Congress passes the 16th Amendment, which would eliminate the apportionment requirement mentioned above. That's no longer going to be an issue. They can tax people differently based on their incomes. So the amendment read as follows. Congress shall have the power to lay and collect taxes on incomes from whatever source derived without apportionment. Boom, right there. You don't got to do the head tax where, again, if New York has to raise $2 million and there's $1 million residents, $2 per person. No, you can have residents $10, $7, $2, $1, depending on your income. And then you don't have to even look at the proportionality and census of the states. We just focus on, hey, this is your income. This is how much tax you have to pay. Okay, which is the current system we have today. So again, 1909, we have a corporate excise tax, and then we also have the 16th Amendment passed, but it hasn't been ratified by the states. So in 1911, we have a U.S. Supreme Court case that tests the constitutionality of this corporate excise tax. The case was called Flint v. Stone Tracy. The court rules that the tax was a special excise tax on the privilege of doing business and therefore did not violate the constitutional issues mentioned above from the Pollock case. Finally, 1913. Huge year, right? A huge year. All right. So in 1913, we've got the ratification of 3/4 required to enact in the Constitution the 16th Amendment. So yes, Congress passed the amendment, but then the next step, as you all know from U.S. government, is then the states have to ratify. The 3/4 requirement was met, and then the 16th Amendment was added to the Constitution. And this allows, among other things, it allowed for the ability, again, where Congress can lay and collect taxes on incomes from whatever source derived without apportionment among the several states. So there's no apportionment requirement. Therefore, that means that now the Pollock case is pretty much overruled by Congress, because now an income tax could take place. And then guess what happens in 1913? We have immediately the first constitutional tax law, the Revenue Act of 1913. The first constitutional income tax, I should say. Revenue Act of 1913. So this ranged from 1% on income to 7% on income based on how much you made on income. Now, one thing I want to do at this point is, since we're at 1913, which is the beginning of our income tax continuous, I want to focus on the historical charts of tax rates. And we're going to look at specifically the normal ordinary tax rates, the long-term capital gains rates, and the corporate income tax rates. We're going to look at all three of those. We're going to look at the highest of those rates. So we're going to look at three different charts, and I want you to look at and notice something from the history of 1913 until the time of this video, or a little bit before that. And you're going to see how ordinary tax rates, long-term capital gains rates, and corporate income tax rates, what they looked like over this period of time. Okay, and even going on in the future, past this video, it's helpful to look at the beginning of the income tax to your year and see how the tax rates have changed, because that affects taxpayer behavior, which I'm going to mention in a moment. But let's go ahead and look at the different graphs, the different historical charts. All right, so what you see here is the maximum income tax rate, the ordinary tax rate. And what you notice is we have 1913, this is going to about 2000. What you notice is that it's going to rapidly jump right around World War I for raising of revenue for a war, right? So between 1915 and 1920, you see it drastically jumps from just below 10% to all the way almost to 80%. Then it starts going down in the 20s, and then we come to 1930s, early 1930s, the New Deal. It starts going up because we have certain different fiscal policy, and then notice it gets the highest during World War II, over 95%, in some years during World War II to raise money for World War II for the U.S. Then for quite a while after World War II, going into the 50s, the 60s, we're hovering around 90%. Then we drop down to about 70% going into the early 1980s. Then we're still kind of high, up to around 50%. Then we have the Tax Act of 1986, where there's a change in the landscape, and now it drops down to about less than 30%. And then since then, we've been hovering around less than 40% is the highest ordinary tax rate. So that deals with ordinary tax rates. Let's take a look now at the historical or the highest, I should say, the historical chart for the highest long-term capital gains rate. All right, so what you see here, this is a chart that in blue, we have our ordinary tax rate that I just mentioned, highest ordinary tax rate. And then in the gold or the orange color, gold and orange, you see the highest long-term capital gains rate. And what you notice is that starting off, they pretty much mirror one another. But then when we come to the 1920s, there's a divergence, okay? So it starts off the same. That's why you see the golden first. And then all of a sudden you see around 1920, you're going to see two different graphs. They've now broken off. And notice that in the years that we have over 90%, it's hovering to the mid-20s, okay? And then some years, when it's 70%, it goes up to close to 30, 40%. But historically, capital gains rates have fluctuated around 20 to 35, 40%. And for most part, they stay in the 20%. So this is how a lot of taxpayers from 1913 to before the 1986 Tax Act, this is how a lot of the wealthy taxpayers did not pay 90, 80, 70% marginal tax rate at the highest rate because they had a lot of their wealth in long-term capital gains. So long-term capital gains, that's a concept for exploring in your income tax courses, but just keep that in mind because you're going to see that when it comes to some tax rules, and I'll give you some examples in a moment, taxpayers would rather structure their transaction as a long-term capital gain to potentially save 50, 60% in taxes. If you're dealing with, let's just take around 1950, and you're in the highest ordinary tax bracket, which we're going to say is 90%, just to keep it simple. It's probably more than that, 90%. And we're going to say the highest long-term capital gains rate, we're going to say is 28%. So 90 minus 28, you're talking about 62% tax savings. If you're dealing with $1 million, because a lot of wealthy people back then, ultra wealthy, had $1 million transactions, you're talking about saving $620,000. Okay, $620,000, 62% tax savings. $620,000, that's a lot of tax savings by characterizing a transaction as long-term capital gains rather than ordinary income on the transaction. So that's one big thing to keep in mind whenever you're dealing with an income tax course, because it shows that taxpayers are looking for ways to lower their taxes, and one way to do that is to look at the different tax rates. So let's take a look also at the highest. All right, so here is a graph that actually shows you income tax rates, capital gains rates, and corporate rates, highest marginal rate altogether. So what you notice, we've already looked at the income tax and the capital gains rate both. What you notice now is, and you'll see again, we have in green the highest ordinary income tax rate. In the gold or the orange color, we have the highest capital gains rate. We just talked about that. And now in this grayish color, we have the corporate tax rate. What you notice is that the highest corporate tax rates, generally speaking, from 1940 to 1980 were lower in the 1980s, were lower than the highest individual tax rates. So that was another strategy that individuals tried to use, was maybe put their money into corporations and be subject to corporate income tax. Yes, there's a potential for double taxation, but one thing about corporate taxation is that you keep your money separate from your individual taxes. It does not flow through like partnerships or S corporations or sole proprietorships, and you could also time that. So you'd be subject to a lower tax rate, and then if you weren't subject to the second level of taxation because you retained the money, then you could get taxed. Let's say you're 1950, where the highest corporate tax rate is around 40%, and then again, the highest ordinary income tax rate is around 90%, you could save 50% in taxes by using a corporation. Again, assuming that you were able to plan around not having the second level of taxation, which a lot of taxpayers did. So that's another strategy. So let's go back to our notes, our materials, and talk about some examples in the tax law where you can see this issue, or you see the rules, how Congress has basically stopped these abuses because of taxpayers playing games. One example deals with shareholders of corporations withdrawing earnings of the business through redemptions of stock by corporation. So basically, rather than receive a dividend from a corporation, a shareholder would sell stock back to the corporation, still have the ownership percentage or control, if they had enough ownership of the corporation, and that would be characterized under the law one time as the sale of stock, which would be long-term capital gain if held for more than a year. Congress came in and said, it's too good to be true. So what it did is it put in special rules, what we call the redemption rules under Section 302, and basically said, unless you have certain criteria, we're going to treat that transaction as a dividend where it's taxed at ordinary tax rates. Because back historically, dividends have been taxed at ordinary tax rates. So if you're in the highest bracket, you'd be subject in 1950 to that 90% rate on the ordinary dividend, rather than selling your stock and be subject to a 28% rate on the sale of the stock for the long-term capital gain. Another example, again, as I mentioned, because like in 1950, the highest ordinary tax rate was 90%, the highest corporate tax rate was 40%, individuals would conduct business through a C corporation rather than as an individual, and then, a sole proprietorship or a flow through like a partnership. And then by doing that, they would be able to plan around and not be subject to double taxation, because they would not withdraw money from the business. They would retain their earnings in the business, and they'd only be subject to a 40% tax rate rather than a 90% tax rate. So let's continue on. That just shows you that based on the history of the tax rates, and look at those charts. Focus on those charts again. Take some time. I've showed you here in this presentation, but take some time to focus on those charts. What you see is that taxpayers generally try to lower their taxes, and they do so using different tactics and planning. And that's why there were a lot of tax cases that took place and a lot of tax laws that took place between 1913 and 1954, because people were playing games when the tax law was so new. All right, so after 1913, we have 1916. The U.S. Supreme Court upholds the progressive income tax structure in Bresharber versus Union Pacific Railroad. So before 1913, generally speaking, we saw this in the Civil War, right? There was different tax brackets, but generally speaking, the taxes were like one rate. So when the taxes come out in 1913, 1914, 1915, when they're changing for the different tax laws, there becomes different tax brackets based on, how much money you've earned in income. And this case basically challenged the fact that, hey, I made more income, I shouldn't be taxed at a different rate or a higher rate than someone that makes lower income. Well, again, our system goes back to the whole idea of the ability to pay from British, and the more and economic ideas, and we're not going to go into those, but we will mention policy later on that talks about the ability to pay. But with respect to ability to pay, one element deals with progressive tax. The more money you make, when you start paying taxes or certain elements in economics, items aren't as valuable as, let's say, if you don't make as much money. That's basically the idea of ability to pay. So 1916 and 1939, there's 17 different revenue acts. And this becomes basically a mess. There's all these independent pieces of legislation, as Congress did not basically put them all together. There's all these inconsistencies, deadwood provisions, modifications. So if you're a researcher, you got to go through and look at all 17 different acts. This is really a pain. So finally, to solve this issue, Congress in 1939 creates the first Internal Revenue Code of the U.S. Title 26 of the U.S. Code. This is our first tax code. So this is a 1939, our first tax code. Single location where you find all the tax provisions enacted by Congress. The first tax code. 1954, we have our second tax code. So Congress decides to reorganize the code using the numbering system. And that numbering system you're going to see in 1986 has stayed pretty much the same in 1954. But one thing to note is that in 1954, with the renumbering, you might have a code section in 1939 code. For example, section 17J of the 1939 code was renumbered section 1231, which is a big code section in income tax. And then the element or the issue becomes when practitioners are doing research and they find a case or some type of authority prior to 1954, you're going to see that it's referenced under section 17J. Well, the point is that when you're doing research, you can still rely on that. Just because the number changed doesn't mean the law has necessarily changed. Code section 1231 has been around for a long time. The idea has been around for a long time. The application has been around since for a long time. So provisions you find prior to 1954 tax code using section 17J, they still can be used today, even though code section 1231 is now the proper code section. It's been that way since 1954. Okay, so that's our second tax code. In 1986, we have our third tax code. And remember, as you saw in the tax law changes, the rates in 1986, there's a huge change when it comes to the policy of tax. We go from a system of both revenue raising and wealth redistribution to pretty much just a philosophy of revenue raising, where the tax rate goes from 60, 70, 80%. We even saw 90% in the 50s and the 40s, right? To the highest tax bracket being 28. And it's pretty much flat, a flat tax. Okay, so the tax rates go down significantly, and more of a flat tax in the sense there's less tax rates, but the income broadens through the provisions. So there's a philosophy change in the law. And now we have our third Internal Revenue Code, which at the time of this video is the same is the Internal Revenue Code we're still using. And the idea there is that the 1954 tax code, the numbering system, stayed the same for 1986. But again, there was a change in the philosophy of the tax law through the Tax Reform Act of 1986. So we have our 1986 tax code, our third tax Internal Revenue Code. So then we have a bunch of provisions after 1986. Some examples are 1993, 1996, 2001, 2004, 2017. There's major tax legislation each year, but these years are significant. So you can probably go through different years and see, hey, in this year there was some significant tax law changes, and that was from a tax bill or legislation. That goes in and it adjusts the 1986 tax code, and we have those provisions. So this is just really a brief overview of the history of the income tax law. Of course, there's other elements, but these are the major elements. Now, whenever you're reading the tax law, you're going to see that some key dates are referenced. For example, when you look at code section 316, 317, 312, dealing with earnings and profits. Earnings and profits, it specifically says in the tax law, for purposes of classifying dividends, no amounts prior to March 1st, 1913 are included. Now, why is 1913 significant? Because as we saw, 1913 is when we have our first income tax law. Okay, that's constitutional. After the 16th Amendment, that's continuous, our first continuous, right? That's the year of the first continuous income tax law. We had some income tax law before that, but again, it was viewed as constitutional. So you're going to see years in the tax code that pertain to some of these key provisions. So just keep your eye out for those, and your mind open to these historical issues because they're very important. So one example is 1913. All right, so that deals with history. The last element in the introduction to tax law deals with tax policy. What makes a good tax? So as we've talked about already, the main purpose of tax is to raise revenue. There's no such thing as a perfect tax. But you might be wondering, what makes a good tax? If we have a tax, let's at least have a tax that's not, it's the best of the evils, right? It's you don't want the worst of the evils. You want the best of the evils. You want to eliminate certain issues. Tax, of course, is going to be, no one's going to be happy. There's no perfect one. Not everyone's going to, I'm sorry, I shouldn't say no one's going to be happy. Not everybody will be happy when it comes to tax. So the elements or the issues to consider, how can we have a tax that's a good tax? It's as good as it can get. Now, Adam Smith in The Wealth of Nations suggested some elements to consider, and we still use some of those elements today whenever we view tax policy. So a good tax should be simple, fair, and it shouldn't affect economic transactions. We label those three criteria: simplicity, equity for fairness, and efficiency for the economics. So let's first talk about simplicity. So this is a big one. Whenever you see politicians talking about tax law, the first thing they usually focus on, because it's the easiest for constituents to get their mind around, we know the tax law is extremely complex. We know filing a tax return can be difficult. So they love to focus on simplicity. We need to make the tax law much simpler, right? If you look at all the volumes of the tax law, right, if you shot a gun through those tax law, those tax codes, if you pulled out the tax codes from the U.S. code, for the U.S. tax code, the bullet would get stopped right in the middle because there's just so much pages of legislation. So in terms of simplicity, The tax should be simple to administer for both the government and the taxpayer. So not only having a simpler tax make it easier for the government, for a taxpayer, but also the government. So there's really two elements we focus on when we look at being simple: certainty in application and administrative convenience. So of course, when it comes to a simple tax, the more certain the application is, makes it easier for both the government and IRS to administer. So that is very important. The more changes we have or the more difficult the provisions, that makes the certainty much more not uncertain. The next element is that's part of simplicity, deals with administrative convenience. The more convenient for the government to administer and for the people to pay, the more likely we're going to be able to collect the revenue that taxpayers actually owe. Because if the government, if it's administratively inconvenient, then we have what's called the tax gap. The government is going to put in money for the IRS, the Treasury, these different tax elements of the government to come and try to enforce and collect the tax, but they're not going to be able to enforce 100%. So the idea is that the more money we put in, at what point do we get return on investment, actual return? So we create this tax gap, which the tax gap is basically the amount of tax we're collecting versus the amount of tax that we should be collecting in a theoretical 100% situation. And what you notice, if you actually look this up online, I recommend you do, there's a very large tax gap. It's in the hundreds of billions of dollars. But the idea is that in order to get that marginal dollar from that, investing more money, it might not be worth it. It might be a negative return on investment. Also, with administrative convenience, if it's more administratively convenient for the taxpayer, they're more likely to pay the tax, because if it's easier system, they're going to say, okay, I'm going to just fill out the tax return, boom, simple. But if it's more administratively inconvenient, taxpayers might get frustrated with the system and be like, why am I doing this? I'm just going to not do it because the government can't figure this out either, anyways. So you got to think about elements like that. Okay, so the next element of tax policy, we just talked about simplicity. That's the first element. Next is equity or fairness. So a tax should be fair. Now, again, there's no perfect tax, so there's going to be lots of situations of unfair tax systems. Now, when we look at fairness, we really focus on two types of analysis: horizontal and vertical equity. So horizontal equity deals with focusing on two taxpayers that are in similar situations and looking at economically and if they're paying the same amount in tax. So again, we focus, I mentioned this earlier, on ability to pay. So the ability to pay notion, and again, this comes from our British counterpart, which, remember, U.S. tax history, a lot of our elements from the 1700s and 1800s come from the British system of tax. The ability to pay is an economic idea from the diminishing marginal utility. The concept is based on empirical observation that the more one has of a particular thing, the less valuable it is to him or her. So, for example, food or housing. The more you have, the less valuable it is versus the less you have. So someone that has a lot of food, it's not as valuable as someone that doesn't have as much food, because when you start thinking about necessities in life, I need this amount of food to live, it becomes a lot more crucial for the person that has less food. That's more valuable to them, more scarce to them, because they actually need it to live. If you have a ton of food, you have what you need to live, but then you have more. So the idea there is like discretionary income or discretionary ideas where above what you need to live. And then again, this marginal utility concept, where if you have one ice cream versus 10 ice creams, you have more marginal utility from the first ice cream than the 10th ice cream. You get more marginal utility from that, more satisfaction from that. So in US, again, we have an ability to pay system. That's why we have a progressive structure. Now, certain taxes like real property taxes, they're more based on a flat system, but still ability to pay is really an element in all of these, because in sales tax, the more you buy, the more you're paying in tax. Same with real property tax, the more value, the more you're paying. It's not just simply, it's a flat tax percentage. So keep that in mind in the equity and the efficiency arguments, the ability to pay. So horizontal equity, again, we're focusing on taxpayers in similar economic situations. They should be paying the same. The idea here is that if we have two taxpayers that economically, their economic unit has about the same amount of income, should they be taxed the same? So you might have one taxpayer that is making a lot of money in wages, but then their spouse divorces them, and now they're paying some of their money to that other spouse through alimony. Well, the idea is that should that alimony be taxed? Should it be deducted from the person that's paying it, and should it be taxed by the other party? Versus, what if you have someone that's married and they have a stay-at-home spouse? The stay-at-home spouse doesn't make any money, but then that one spouse makes the same amount of money as the other. Well, they might not be able to deduct the amount of taxes the amount they pay, or for providing for the other spouse, even though the other spouse doesn't work. So the idea there is, when we have alimony, that might create a tax deduction, but then when you have this economic unit where only one spouse works, and let's say that again, taxpayer A in both situations makes the same, taxpayer B doesn't work, taxpayer B is getting alimony in situation one, taxpayer B is not getting alimony but just living with taxpayer A as spouses. The idea is, should the alimony in situation one, should that be deducted from taxpayer A, when in situation two, again, the two taxpayers, they're pretty much living off the same income just like they are in situation one, but they don't get the deduction. So is that fair? That's kind of what we're looking at, those types of issues. And we're determining, hey, giving a deduction for the alimony, some people might say it's not fair because if I'm one spouse and I'm the only spouse making money for my family, that could be viewed the same way. Of course, there's the issue of divorce and ex-spouses and whatnot to consider. But again, when you look at, okay, one spouse is providing for two people, it's very similar. Vertical equity focuses on taxpayers in different situations, different economic situations. So you have a taxpayer in a higher situation versus a lower situation. This is where the ability to pay element comes into play, because that's why we have our progressive structure. The less you make, you have a lower tax rate, a lower marginal tax rate. And then the more you make, you have a higher marginal tax rate, because the pain of you paying that tax and not being able to use that money to buy various items, necessities needed to live, provides more pain. Versus if you make more money, well, you have the items you need to live, and then pain is not as bad. The only issue with this is that economists have not been able to empirically prove that declining marginal utility of money. So if you have more money versus less money, if that creates a marginal utility, like the more money you have, is it less utility? Of course, the more food you have, again, the more you have, the less marginal utility at that level. So that's, again, why this ability to pay element is so important in our system. Again, whether you agree with it or disagree, you think maybe we need a flat tax system, that's another argument, but that's what our system has, the ability to pay concept. And vertical equity, it looks at situations where taxpayers are in different economic situations, but then one taxpayer, do we think they should be paying more or less or whatnot? So the next and last element is efficiency. We're focusing on the economics of the transaction. And the idea here is that an efficient tax is one that does not influence a taxpayer's decision or decisions. Now, as we know, stressed many times throughout this video, the main goal of taxes is to raise revenue for governments. But another goal might be social policy, which I'm going to mention in a moment. So we actually might want to encourage certain behavior. But generally speaking, economists, especially when you're looking at free market ideology, taxes should not affect behavior. You should not be buying certain, items from a store or not buying them, one versus the other, because there's a higher tax on one thing versus the other. Taxes should not make an element. We should just let the free market make those decisions. Supply, demand, and prices make those decisions, not taxes. That should not be part of that. That's what the free market ideology says. Now, as I mentioned, Congress might want to encourage certain behavior through Keynesian economics. And as you know, there's different subsidies that Congress and different political parties, they advocate for. Tax law is one way to indirectly do that through tax expenditures, we call them. Through ways to carve out through the tax law different tax provisions where maybe you get a tax benefit by owning a home, or you get a tax credit from sending your child to college, stuff like that. We want to encourage certain behavior, or get an energy tax credit. the idea there is you might want to question Congress's intentions. Are they, do we agree with them? Do we not agree? That's part of a good tax system, analyzing a good tax system. Again, a good tax focuses on fairness and also efficiency. Do we want to encourage taxpayers to act a certain way? Do we not want to encourage them to act a certain way because we want the free market to take over? All those things are elements in the efficiency standpoint. So I have an example here of Section 4681, assesses an excise tax on ozone, so you actually have to pay more when you're violating the ozone, violating the environment. But IRC Section 169, so Tax Code Section 169, is an example of a provision that encourages socially desirable behavior because it allows for immediate deduction of construction of pollution control facilities, which help the environment by not allowing all this, these harmful items, chemicals and whatnot to kill the ozone and whatnot. So that's an example where you see two provisions. One is meant to try to stagnate or de-incentivize certain behavior, and one is meant to incentivize certain behavior. One's meant to de-incentivize harming the environment, and one's meant to incentivize helping the environment. Okay? So whether you agree or disagree, again, as I mentioned, this is what we have in our tax law, tax system. You have to understand that's what goes into it. The social policy goes into some of these provisions. Okay, and I talk here about, again, tax expenditures, how these are kind of backdoor ways that the government might try to have an indirect subsidy by providing, oh yeah, this is lost revenue we would have raised if not for this provision. That's all important when you're looking at whether it's a good tax or not. One thing I want to mention, when you're dealing with efficiency, there's one, and again, taxes affecting certain behavior. There's one group of taxpayers in particular that they've done studies on that do affect behavior, and that's house spouses. So the age-old question of whether a spouse, when spouses have children, should stay home and go to work, or go to work and send children to daycare or whatnot, have someone watch the kids. Taxes have made a huge impact on this decision. It's one of the main areas where taxes have made a decision. So think about it. If you have two spouses, spouse A and spouse B, let's say spouse A is a lawyer, or an accountant, tax lawyer, tax accountant. Let's say they make six figures, they're making a decent amount of money, and the other spouse is an elementary school teacher, and this couple of spouses, they have twin children, just had them, okay? Or adopted or whatnot. Well, the question becomes, should spouse B, who makes not as much money being a teacher, maybe just does it because spouse B loves being around children and helping children out in the school, should spouse B stay home with the children, the twins, and pretty much raise them rather than pay someone to come, a nanny or a daycare, to watch the children, which is going to be significantly expensive, maybe even more than what spouse B actually makes. And you also have to consider that spouse B has to pay tax on the income that spouse B makes at the school. So you'd have to actually make more and then actually be able to pay. Now, yes, you'd have to make more income, and then you're taxed on that income, and then you actually pay you pay the provider, the nanny, or the daycare, right? But the idea is you're making more than what you actually have to pay because you're subject to tax on that. So taxes do have an effect. Now, yes, there's certain incentives, like there's credits or deductions for there's child care credits. But maybe because the spouse A already makes so much money that those spouses are outside the phase-out range, maybe those tax credits or tax benefits they've been thrown out the door because they make so much money and they're married and they file joint. Okay? You got to think about all these different things. But I'm just going to tell you that in these situations, taxes have made an impact. They've done studies on this, on these spouses, in terms of whether spouse B should just stay home, raise the children, or go to school, work at school, make money, but then be taxed on it, so you have net money of less, and then have to pay a provider when maybe spouse B just wants to stay home with the kids anyways because spouse B wants to be with the kids and be able to raise the kids and just know that that those kids are going to be raised and be able to enjoy the time with those raised properly and be able to enjoy time with the kids. All right, so that really concludes the introduction to tax law. These are just some major aspects to tax law. I think this is what whenever you go into a tax class, you should think about these things. What exactly is a tax, right? Comparing and contrasting a tax versus a fine or penalty or a fee or a toll, right? And then the types of taxes. We talked about income taxes, personal property taxes, real property taxes, sales taxes, use taxes. We talked about all these different types of taxes, as well as the governments that try taxing you. Then we talked about the history of the federal income tax. We went through that, and that's also very important, understanding where we are with the Constitution, our tax system, the way it is. Again, different times, how it was unconstitutional. Looking at the charts of the different tax rates, because that makes an element when you start looking at micro tax issues like different provisions and why Congress tries to stop taxpayers from redeeming money or redeeming stock from the corporation rather than just getting a dividend, and how that tax law is developed, and looking at the different tax codes and the philosophy, and finally focusing on tax policy, the three elements: simplicity, equity, and efficiency in determining what makes a good tax. So I hope you've enjoyed this video. Please make sure to continue with your tax exploration and keep these elements in mind.